The kitchen fire did about $90,000 of damage. The house was still standing. The family expected the policy to cover the repair minus the deductible. The adjuster ran the numbers and approved the claim. Then the check arrived, $54,000, not $90,000. The family called, certain it was an error. It was not. It was a clause. The home had been insured for too little, and a single provision quietly cut every dollar of a loss they never knew was at risk. The provision is called coinsurance. It has nothing to do with the coinsurance on a health plan. In property insurance, it is a deal about how much of your home's value you agree to insure. The standard requirement is 80%. Carry coverage equal to at least 80% of the cost to rebuild, and partial claims are paid in full. Fall short, and the insurer can pay you less, even on a small loss. Notice what this is measuring. Not the price you paid, not market value, not the land. It is the cost to rebuild the structure from scratch, the replacement cost. That number is often higher than people assume, and it moves every year. Lumber prices rise, labor costs climb, codes get stricter. A home insured correctly in 2018 can be badly underinsured today, not because the owner did anything wrong, but because the cost to rebuild kept climbing while the coverage sat still. So here is the family situation. Their home would cost $200,000 to rebuild today. To satisfy the 80% rule, they needed at least $160,000. They carried $120,000 and thought it was plenty, since most fires do not destroy a whole house. They were right about the fire. The damage was only $90,000. But the penalty compares what you carried to what you should have and shrinks the payout by that ratio. The math is a formula. The insurer divides what you did carry, $120,000, by what you should have carried, $160,000. That ratio is 75%. Then it pays only that fraction of your loss. $90,000 times 75% is $67,500. Subtract the deductible, and you land near the $54,000 on the check. The $36,000 gap was not a denial. It was a penalty for being underinsured. Why does this clause exist? The logic is fairness in pricing. Most claims are partial. Kitchen fires, burst pipes, storm damage rarely level a home. If everyone insured for half the rebuild cost, they would pay half the premium but still expect full payment on partial losses. The insurer would collect too little. The clause pressures you to insure to value by penalizing you on every claim if you do not. The cruelty is in how it is discovered. The clause is on your declarations page, a single line of jargon among dozens. No one explains that the coverage amount is not just a maximum you collect in a total loss. It also governs how much you collect in a partial one. By industry estimates, around 2 in 3 homes in the United States are underinsured to some degree. Most owners find out only when an adjuster runs the calculation. The penalty compounds with replacement cost versus actual cash value. Replacement cost covers rebuilding with new materials. Actual cash value subtracts depreciation first, the wear and age of what was lost. A family that is both underinsured and on an actual cash value policy gets hit twice, once by the coinsurance ratio, again by depreciation. A $90,000 loss can shrink to a payout that does not even cover the repair. For this family, the $36,000 shortfall came out of savings because the repair still had to happen. The contractor did not reduce the bill to match the check. The gap was theirs to close. They had paid premiums for years, everyone on time. The coverage worked exactly as written. What was written and what they believed were two different things, separated by one line they had never been asked to read. How do you avoid this? Start with the right number. Find the replacement cost of your home, not the market price and not what you paid. Your insurer can run an estimate, and an independent appraiser can confirm it. Then make sure your dwelling coverage, the figure labeled Coverage A, meets or exceeds the requirement, usually 80% of that rebuild cost. The extra premium is nothing against a $36,000 penalty. Then keep that number current. This is the step almost everyone skips. Construction costs rise, especially after a regional disaster. The amount you set 5 years ago can be badly out of date today, even if nothing about your house changed. Review your dwelling coverage every year. An Inflation Guard endorsement nudges it up automatically, though it can lag a fast market. Consider a guaranteed or extended replacement cost endorsement. A standard policy caps you at your coverage amount, so if rebuild costs surge past it, you are short again. An extended endorsement pays a percentage above your limit as a cushion. A guaranteed endorsement, where offered, pays whatever it actually costs to rebuild. It is the strongest protection against this trap. Not every insurer sells it. Ask whether yours does. And read the declarations page line by line, once. Find coverage A, the dwelling amount. Find the coinsurance percentage, usually 80%. Find whether losses settle at replacement cost or actual cash value. 3 figures, a few minutes. Those lines decide whether a future claim is paid in full or quietly cut by a quarter or more. The adjuster only finds the gap after the loss. The one time it is cheap to know is right now. One more wrinkle. The coinsurance test is applied at the moment of loss, using the rebuild cost on that day, not the day you bought the policy. So even a diligent owner can be caught by a market that moved. This is why the annual review matters more than the original purchase. Insuring to value is not a one-time decision. It is a maintenance task, and neglecting it costs tens of thousands of dollars. The family repaired the kitchen. They raised their coverage to the full rebuild cost and added the replacement cost endorsement they should have had all along. It cost a little more each month. It will never again cost them $36,000 on a single claim. The coverage amount on your page is not a promise of what you will collect. It is a test you have to pass. The fine print just never told you it was graded. If this one stayed with you, episode 23, replacement cost versus actual cash value, the two words that decide if your home is rebuilt goes further down the same road. It is on this channel. The other half of this trap,